How does securitization use financial engineering? Have you ever wondered how financial systems turn everyday loans into tradable investments? The process of securitization is a fascinating example of financial engineering at work. Let's break it down in simple terms. Securitization starts with gathering a large number of similar financial assets, like mortgages or auto loans. These assets are pooled together to create a single entity. This pool is then transferred to a special purpose vehicle, which is a separate legal entity. This step helps isolate the assets from the original lender's balance sheet. Now, here's where the magic happens. The special purpose vehicle issues securities that are backed by the cash flows from the underlying assets. These cash flows include interest and principal payments. Investors can then buy these securities, which representing a claim on the cash flows generated by the asset pool. A key element of financial engineering in this process is called tranching. This means dividing the pooled assets into different layers, or tranches, each with its own level of risk and return. The senior tranches receive payments first and are considered safer, usually offering lower yields. On the other hand, mezzanine and junior tranches carry higher risk but also promise higher potential returns. Think of it like a waterfall. The cash flows cascade down from the safest to the riskiest tranches. This structure protects senior investors from initial losses while exposing junior investors to greater credit risk. By customizing these tranches, securitization allows investors to choose securities that fit their risk tolerance and investment goals. Financial engineering also involves using credit enhancements to improve the quality of the securities. This can include over-collateralization, which means holding more assets than necessary to back the securities. Other enhancements might involve reserve funds or guarantees from third parties. The rules governing cash flow distribution are also detailed. They dictate how early repayments are handled and what happens if the performance of the assets declines. Historically, securitization began in the 1970s in the United States. It was initially used to solve liquidity issues in mortgage lending. Government-sponsored enterprises were the first to pool mortgages and issue pass-through securities. This innovation allowed lenders to tap into national capital markets and better manage interest rate risks. Over time, securitization expanded beyond mortgages to include various asset classes. It has become a fundamental part of modern financial markets. For banks and other originators, securitization helps remove assets from their balance sheets, freeing up capital for new loans. Investors benefit too, as they gain access to diversified, income-generating securities tailored to different risk profiles. However, the complexity of these securities can make them tricky to analyze and price. The layering of tranches and credit enhancements can obscure the true risk of the underlying assets. In the grand scheme of financial history, securitization represents a major innovation. It has reshaped financial markets by creating new ways to mobilize capital and distribute risk. This evolution reflects the growing sophistication of financial engineering techniques, allowing markets to adapt to changing economic needs.